Imagine looking back at 50 or even 60, realizing you missed out on the chance to live the life you wanted, simply because of mistakes you could have avoided. Scary, right? But here's the truth. It's happening every single day to thousands of people who could have done things differently. Today, I'm breaking down the top 5 investment mistakes that are secretly stealing your wealth potential. If you want to build a future of financial freedom and never worry about money, stick around. These are mistakes you can't afford to make. Alright, before we dive in, think about this. Every mistake you make in your investment journey today isn't just costing you a bit of cash, it's costing you a piece of your future. A lavish lifestyle, freedom from a 9-to-5, or the dream home you picture. Every misstep means those dreams get a little further away. First up, the most underrated mistake is waiting too long to start investing. There's this myth that you can wait until you're settled, get a job, start saving, then invest. But here's the reality. The longer you wait, the more time you lose, and time is your best friend when it comes to building wealth. Here's the deal. A $100 investment at 20 years old can grow to almost 10 times that by the time you're 60, just because of the time it had to grow. Now imagine if you waited until 30. That's 10 years of lost growth, and believe me, it adds up. So, if you're 18, 25, or even 30, start now. Don't let someday become your excuse for staying stuck. Question for you. What would you do with an extra $500,000? Because that's the kind of difference we're talking about if you start early. Let's talk about the FOMO problem, chasing the next big thing. Think about crypto, meme stocks, or any flashy investment trend that promises instant riches. Every day, people get caught up in the excitement and throw their money into something they don't really understand, hoping to get rich overnight. Here's the catch. Most of these trendy investments are just that, trendy. They come and go, and by the time you hear about them, it's often too late. It's like hopping on a roller coaster blindfolded. You might go up for a while, but sooner or later, there's a drop. And if you're not prepared, it's going to hurt. Real wealth isn't built on hype. It's built on steady, smart investments in assets that grow over time. Now, here's something that might shock you. There's actually a common mistake that even smart investors make, and it's just as dangerous. Here's that shocker I was talking about. Putting all your money into a few investments, or even just one, is like trying to balance on a single leg. One stumble, and you're done. Diversification is your safety net. If you have all your cash in tech stocks, what happens when the tech sector dips? If you're only investing in real estate, what happens during a market crash? Diversification spreads your risk across multiple investments, stocks, real estate, maybe even bonds, so one bad day in the market doesn't take you down with it. Here's a little thought experiment. If you had $1,000 to invest, would you put it all in a single lottery ticket or spread it around? Exactly. Diversification is like having multiple shots at winning. Now, this one might sound familiar. Emotional investing. Maybe you've bought or sold because you felt excited or panicked. But guess what? Your emotions are probably the worst advisor you could have. The market goes up, it goes down. That's the nature of it. But making impulsive decisions, especially selling during a downturn, can lock in your losses and destroy your returns. When you let fear or excitement control you, you're letting go of the one thing that makes investing work: strategy. So, next time you feel that urge to do something with your investments just because they're fluctuating, take a breath. Remember, wealth is built on patience and strategy, not panic. Speaking of patience, there's one final mistake that traps more investors than you'd think. And now, the silent wealth killer: fees and expenses. Every time you invest in a fund, buy a stock, or pay for an advisor, there's a fee involved. On the surface, 1% or 2% doesn't sound like much, but when you add that up over decades, it can eat away at thousands, even hundreds of thousands of dollars of your potential returns. It's like having a tiny leak in a bucket. Over time, you're left with way less water than you started with. The best thing you can do is look for low-cost investment options like index funds and keep an eye on what you're actually paying. Remember, your goal is to keep more of your money working for you. Quick math quiz. Would you rather lose 1% of $1 million every year or keep it? Yeah, we're trying to keep our cash here. So, there you have it. The top 5 investment mistakes you must avoid if you want to build true wealth. Now, here's the thing. Avoiding mistakes is just the beginning. Imagine if every dollar you invested could double or even triple over time. Sounds like magic, but it's actually math, and it's called compounding. If you want to learn how to unleash the power of compounding and maximize your wealth, check out my next video right here on the screen. Remember, your future self will thank you for every smart decision you make today. Don't leave your financial future to chance. Click to watch now and take control of your wealth journey.